there was just a report which lets me believe that he is going to leave the European banks holding the bag on the silver short position, which peaked in July, right? And since then, the 5 U.S. banks involved have slashed their net short exposure from 28,918 COMEX contracts to just 6,797 by the end of November. And that is a reduction of over 22,000 contracts. Some of the non-U.S. banks have also reduced their shorts, though less aggressively. But in short, banks have been actively in the United States covering silver short positions since July. And this is likely, continuing through November and December, where U.S. banks appear largely, if not entirely, out of the silver shorts, leaving the foreign banks and other commercials with most of the remaining exposure.
You pointed out before a lot of these differences between the monetary and economic conditions in the 1930s when we're on the gold standard, and there's this direct correlation between the U.S. money supply and gold versus now. This is a really different sort of a question. You've also pointed out that in an extreme case, wouldn't it make sense that if there was some kind of a need for more silver, that the exchanges have ostensibly millions of ounces of it, rather than the government going door to door and knocking and trying to get it from 0.5% of the U.S. population? And since Miles Franklin doesn't, we're not required to report any of these just ordinary purchases, that it would be a lot of manpower needed to try to sift through all that and figure out who had it and that sort of thing.
Well, yeah, and you have J.P. Morgan and BlackRock as the custodian of the world's largest silver trust, SLV, the same company who paid a $920 million fine to the Justice Department for suppressing or spoofing the metals market, is allowed to be the custodian, along with their pals BlackRock, of the world's largest silver trust. You would think it would be far easier and more palatable for the world when they look at the world and say, well, what? All we did was close SLV, unless you have a basket, which would be millions and millions and millions and millions of dollars worth. These are the people that actually fund the account typically, like the commercial banks. None of us can take possession of it anyway. So it's an asset that tracks the price, or it's an ETF that tracks the price of silver. And not even that great at that, but it is the largest silver trust in the world. And it would be far easier for JP Morgan to close that account, pay everyone their fair share of what their account was worth at the end of business on Friday, and say to the world, all we did is what the prospectus allows us to do. Now you're sitting on a huge stockpile of silver without breaking any laws or infringing any civil liberties. And, it gets interesting when we talk about JP Morgan, by the way. The Economic Times just came out with a report saying that they hold over 750 million ounces of physical silver, and that's worth more than $40 billion. And it would be the largest stockpile on the planet if that were the truth. The report is very interesting. It says they didn't just stop shorting silver, they actually flipped and became the biggest long in the market. It said that in 6 weeks, JP Morgan added 21 million ounces while closing a 200 million ounce paper short position. So by removing that paper short, they remove the pressure that keeps the price down. And while buying the physical metal, well, this is going to push prices up much higher. They also mentioned that they took 16.6 million ounces out of the registered inventory, and it left COMEX completely gone. We don't know where it went. And when 16 million ounces leaves COMEX, it ain't coming back ever. That would be my guess, in industrial. Silver is what's called a Giffen good. What Giffen good means is the higher the price goes, the greater the demand. Most assets don't work that way. They say the cure for high prices are higher prices. Not with silver, because you have the industrial component of it where you need it to make your Tesla, you make your iPhone, to make your solar panels. And Samsung, which is one of the things you and I talked about offline there, the rumors are that, they've been flying around or Samsung flew to Mexico and to strike a deal. But this is what a Giffen good would be. If you need that silver, and it's called inelastic, by the way, silver is inelastic, which basically means you only need $30 worth of silver to make a $1,500 iPhone. You don't care what the cost of silver costs. You need it. And it represents a very small price or a little bit in a high tech, relative in terms of its cost, a few hundred ounces, maybe in a military grade missile that sells for $5 million. You don't care what it costs. You must get it. And so you get all of these entities fighting with one another, so to speak, a battle between the industrials and the investors. So when you see that kind of metal actually move and leave the marketplace, it's something to watch and be very cognizant of. They also talked about the fact that they moved somewhere in the neighborhood of like 166 million ounces of silver. They moved it 169 million ounces of silver, and they moved it into what's called a non-deliverable vault. Now, this was something that was new to me. I dig in a little bit because I thought either it is or it isn't in the COMEX ecosystem. And it technically, these 169 million ounces, technically they still exist on paper and could be moved into COMEX, but it's legally removed from the delivery system, and it cannot be used for COMEX settlement unless it is re-registered. So, not only have they accumulated 750 million ounces of silver, and they have forever always been the biggest short, but they've flipped from short to long. They added 21 million ounces while closing a 200 million ounce paper short, according to this article. And then at the same time, 16.6 million ounces left the registered category, left the building. Goodbye, silver. And 169 got moved into vaults outside the COMEX deliverable status. This is not defensive posturing at all. This is intentional removal of metal from the delivery pool. And if it is true, it marks a huge shift from suppressing silver with paper to accumulating physical metal. And you want to talk about bullish. At the same time, and you can stop me anytime here, COMEX deliveries have been unusually large all year, Kaiser. In November, which is typically not a delivery month, we had almost 17 million ounces of silver and about 1.5 million ounces of gold that were delivered. In both cases, gold and silver, it's not a delivery month. By just the 12th of December, deliveries have already reached 58 million ounces of silver and almost 3 million ounces of gold, with contracts still being added daily. Now, ask yourself this question, and this is what I've been trying to scream to people. I don't care what the price is doing. It doesn't mean anything. What does mean something is that the people who in just a handful of days deliver, 58 million ounces of silver and almost 3 million ounces of gold. Who's got the money to do this? You're talking billions and billions and billions and billions every single month, right? Since November, 13 months we've seen this, since last November. The people at this level who throw around that kind of bread, they don't do it just for the hell of it. They know what's coming. They do, and they position ahead of the crowd. Now, one way that they're trying to stop the run on all of these deliveries, because there are some banks that are offsides, to slow things down when registered silver continues to leave the COMEX. And when it does, it's gone completely out of the system. And as metal keeps draining, COMEX does what it always does. It raises margins. And now, because prices are running too hot, or not because they're running too hot, but because the delivery pressure is becoming too much. It's building. And so higher margins force levered traders to sell, people who are on margin. And it would typically shrink open interest, meaning open interest is who's got long contracts that could stand for delivery. And, one of the things that, to me, if you look at it as a kind of a pressure release valve for physical delivery, it's not about the price. That's what people think. It's the price is getting too high. No, not this time. I think it's more about all of the deliveries and the people on margin who stand for delivery. They have to unwind their position. But, the idea is get rid of paper claims faster than the real metal leaves, right? But it's not working. It's not working even with lease rates right now around 7%, which are way above normal. It's because the people that are buying this stuff right now are not on leverage. People that are buying this stuff have lots of money and they're standing for delivery. It's kind of like, if you live in a really fancy neighborhood in a gated community down here in Florida, and there are a lot of them, people coming in to buy houses, they're not taking out mortgages. They're coming in and paying with cash. And that's why higher mortgage rates doesn't affect the property in those areas. It's the same thing here, is that rising lease rates only affect those on margin who are trying to use leverage to achieve what they're trying to do. But that's not happening here because the buyers that matter, well, they're not leverage traders, and they're industrial users, they're long-term holders, they're sovereign wealth funds, they're central banks. And so all this really did was move the silver from the weak hands to the strong hands who came in and bought it. And you can see that because normally when they raise margins, price collapses like that. Not this time. In fact, it came right back up. And here we are today. This happened on Friday, and here we are today. Silver's up over $2 again to over $64. And so what was supposed to scare the market just turned in, to kind of a shakeout rather. And the leverage got cleaned out and the available silver got tighter and the price floor got stronger. Something to think about. And this is happening at the same time rates are rising in London again. Lease rates there about 8%. And again, you're talking about how London silver has been the linchpin of all of this, where their paper claims are backed by very little metal, somewhere around 2 billion ounces of paper claims backed by about 140 million ounces. And that used to work when no one asked for delivery, but now they are. And this is a big, big problem. And there's something that caught my eye because I've talked about this a lot. I've talked about Tom Luongo's theory that, and I like to give him credit because he's the one who came up with it. But when I think about it and put all of these pieces together, I'm thinking to myself, man, it's interesting. Now, Tom says, that Trump was upset with the European aristocrats because he believes, and the Bank of England, that they were involved in election interference 2016 or 2020 rather, and the color revolution, all aimed at, keeping Trump out of office. And I want you to think about a couple things and tell you what I see right now. And again, this isn't my theory, but when I put the pieces together, some of these I didn't hear from Tom, but I think about them and put them in. I'm like, yeah, wow, that's got legs. So let's just pretend he is mad at the Bank of England. He's trying to stick it to him, and the European banks, the old money, right? Because one of the things he is trying to do is take money creation away from the Fed. And we'll get to that in a moment. But anyway, so the first thing that he did was to bring all this gold and silver back. Now, for years, gold and silver has flown back and forth between the COMEX and the LBMA, and these Western banks were in concert together to suppress the price of gold and silver. Now, silver, I would argue, was suppressed for the military-industrial complex. That wasn't just the United States. It was France. It was England. It was all of the, all of the Western countries that had strong militaries that used that to keep their thumb on the world, so to speak. And at the same time, gold was used to hold down the price of gold, largely through futures contracts where they go short in New York to drive the price down and go long in London to offset their books, and metal would flow back and forth. And this was done in cooperation between all of the banks in the West. Gold was held down because of something called Gibson's paradox, which speaks to the inverse relationship between real interest rates and the price of gold. So if the West suppresses interest rates for 30 years to create an illusion of prosperity in our 401ks and our house values and keep everyone, borrowing from the bank, using currency, buying bonds, all of the things that the Western bankers would want, you step on the price of gold, right? So this has been going on forever. Well, Trump says, we need to bring all of this gold back because there's tariffs and silver. So don't worry, it'll all flow back. Well, the tariffs aren't there for this. This was about reshoring, right? So all of this metal has come back, leaving the Bank of England rather vulnerable in terms of the LBMA, in terms of the short positions that they have. And this is a big deal, right? Because you have 140 million ounces, but contracts that say 2 billion ounces can stand for delivery. Where's it going to come from? This is an existential threat. That's number one. The second thing that happened was the move, in my mind, to issue the Genius Act. And the Genius Act, well, before I even talk about the Genius Act, let me just say when he came out with the Epstein, so we're going to release the Epstein files, he specifically cited JP Morgan as being involved. Now, that's the old money. JP Morgan is the old money. They represent the old European banks. That is the old aristocrat money. They're all tied together, right? He specifically mentions them. The third thing he does is pass the Genius Act, which allows the Treasury to issue, in essence, create money through stablecoin issuance backed by U.S. Treasuries, giving the Treasury more power, taking it away from the Federal Reserve. Now, this is what a lot of people think got Kennedy killed. So again, the Federal Reserve, the old European aristocrat money that stands behind all of these banks, right? So you got this, all the metal coming back, lying about tariffs to reshore it. You've got naming JP Morgan in this suit. You've got the creation of money, in essence, through taking it away from the Federal Reserve, giving more power to the Treasury, and all of this at the expense of the Bank of England. Now, and the banks in Europe, and what's very interesting is that if there was just a report, which lets me believe that he is going to leave the European banks holding the bag on the silver short position, which peaked in July, right? And since then, the 5 U.S. banks involved have slashed their net short exposure from 28,918 COMEX contracts to just 6,797 by the end of November. And that is a reduction of over 22,000 contracts. Some of the non-U.S. banks have also reduced their shorts, though less aggressively. But in short, banks have been actively in the United States covering silver short positions since July. And this is likely, continuing through November and December, where U.S. banks appear largely, if not entirely, out of the silver shorts, leaving the foreign banks and other commercials with most of the remaining exposure. And so if this all blows up, the U.S. banks have gone long. The European banks are the ones that are exposed to all this. So thinking about what Tom Luongo says, all of these things negatively impact the Bank of England, the LBMA, and all of the European aristocrat or old money banks. So just something to think of. Almost done. Starting January 1st, 2026, silver exports will require state trading licenses from the authorities in Beijing. This matters because China roughly refines about 70% of all the world's silver, not just from its own mines, but from doré imported globally, refined in China, and then historically re-exported to Western markets. That pipeline shuts down in less than 2 weeks. And if you look at everything happening at once, this is way bigger than monetary policy or investment demand, Kaiser. What we are seeing is a strategic resource competition between great powers with industrial demand that is slamming into a constrained physical supply. You got supply shocks from export restrictions like we're seeing, stress inside of the major exchanges like we're seeing, and at the same time, the largest player in the market flipping from short to long. And that makes this very different. This isn't financial, this is geopolitical. And This is about who controls the materials needed to build the modern infrastructure. So I know on one hand, I'm saying JP Morgan just got all this silver as a U.S. bank, but on the other hand, is JP Morgan more U.S. or are its roots more in the European side of things? All I can say to you is this, that the U.S. banks appear to be long. The European banks appear to be the ones left holding the bag. JP Morgan appears to have gone wickedly long. Over 750 million ounces closed out its short position. Things are happening at a level we've never seen. And to see millions upon millions upon millions upon millions of ounces coming into COMEX every single month tells me that the people pulling those strings, they are the most well-funded, yes, but more importantly, the most well-informed traders on the globe. People should pay very, very close attention to that as far as I'm concerned.